So welcome back to my channel Quick Learning. So now our topic is to use financial statement information to evaluate profitability and liquidity. So first of all, you should know that what is the comparison between both of them. I assume that you know the definitions of them. If not, then you can comment me and I can make a separate video on them. Otherwise the video will be too lengthy. So liquidity versus profitability. So in liquidity, you have high investment in working capital and more liquid but may not be using working capital efficiently and less profitable. So profitability means low investment in working capital, less liquid but may be using working capital efficiently and more profitable. So now evaluating the business. So first of all, we have evaluated profitability, that did the business earn a profit or a loss in the current period, and what is the business future potential for a profit. And how you evaluate liquidity, that does the business have assets available to pay debts as they become due. So if you want to check the profitability of the company, you have to answer these questions on the left hand side. And if you want to check the and evaluate the liquidity of your company, then you have to answer the right hand side question. So measures of profitability help users of financial information assess current profitability of a company and future potential for increased profits. So, measures of liquidity helps the user assess the ability of a company to pay its debt when they fall due. So, this is the difference between both of them. So, the risks that you will face in liquidity are, here I quote some examples so that you will understand it better. That inability to meet short-term debt, then unable to meet proper funding within a specific time frame. Then rise of material causes rise in manufacturing expense for the concern. So now evaluating the business by a formula. So if you want to measure the profitability, then you should know the two formulas. Number one, net income percentage, that is equal to net income divided by total revenue of your business. And number second is return on equity. So its formula is net income divided by average stockholders equity. So if anyone asks you to measure the profitability of a company, or is this company is at a profit or a loss, then you can measure the net income percentage and the return on equity. If the answer is a positive value, so it means that the company is profitable, and the more higher the value is, the more profitable the company is. So now evaluating liquidity. So for its measurement, first of all, you should know working capital, that is current assets minus current liability. Then second formula is current ratio, that is current assets divided by current liabilities. So by these two formula, you can know that is this company is liquid or liquidified or not, and how much is the liquidity. So now two common measures of profitability includes the company net income percent and its return on equity. So when a ratio is calculated that has an income measure in the numerator and balance sheet measures in the denominator, an average must be used for the denominator. And for the return on an equity, the together the beginning balance in stockholder equity and the ending balance, then divide by 2. So this is the explanation of the previous formulas. I hope you will understand by this explanation as well, because some people find it more easy to understand in words as comparison to formula. Some find it easy to understand in a formula. So I write both of them so anyone can and everyone can understand. So almost all companies calculating working capital and current ratio. And working capital is the current assets less, or you can say minus current liabilities. And the current ratio is current assets divided by current liabilities. So thank you. That's all from my side. Kindly subscribe to my channel and like and share my video. Thank you.